Hello, everybody. Welcome back to the Accounting Superstar channel. So glad you're here. I'm Professor Don Bush, and I've been teaching accounting for about 30 years and have been a CPA for about that long also. Glad you're here. So today we're going to continue the adventures of, when we get to it, construction. And we're doing accounting for income taxes, deferred tax liability. This is example number 3. And by now, if you've been watching examples 1 and 2, you should be getting the hang of this, as it's not that difficult. It's actually quite easy. So here is what we have going on today. We've got, when we get to it, construction. They do their financial statements using generally accepted accounting principles. And they recognize revenue when it is earned, and in this case here we have unrealized holding gains. When we get to it, construction owns lots of investments. They owned Google, Microsoft, Home Depot, all kinds of investments, and they're doing quite well. And during the year 2001 they had an unrealized holding gain of $120,000. So what is an unrealized holding gain? Well, an unrealized holding gain is when someone owns stocks or bonds or investments, and the value goes up, and the gain is recognized in the financial statements. So they had part of that $120,000 is the unrealized holding gain, and then in 2002 they had some more unrealized holding gains. And 2003, not so much, and 2004, not so much either, but a grand total of $400,000 of revenue. When we get to it, construction uses generally accepted accounting principles, and what's most important is recognizing revenue when it is earned and matching the expenses that it took to make that revenue. Coming down to the IRS and tax code. When we get to it, construction fills out tax forms, and they have to use the tax regulations. And fortunately for when we get to it, construction, revenue in regard to gains is not recognized until the investment is sold. So in 2001, according to the books, they recognized unrealized holding gain, but in 2001, according to their tax return, they did not recognize it because they did not sell the asset. If you don't sell the asset, it's hard to pay taxes. In 2002, $140,000 on the books, only $70,000 according to the tax code here. And in 2003, things are reversed out. They didn't have very much in the way of unrealized holding gains, but they did sell those investments and recognize those gains on their tax return. And the same thing happened in 2004. Now, all together, their total revenue is $400,000. Either way, according to their books or according to their tax returns. Coming down to the third table, this is simply a summary of what's going on in the first two tables. So we have income tax expense according to GAAP of $12,000. Where did that come from? It came from the top chart here, $12,000. And you can see that every year is just simply carried down. $16,000. Here is $2,000 carried down, and so on and so forth. The grand total tax expense is $32,000, and I've got $32,000 right here. The next line, income tax payable according to the tax code. Well, that comes from this line here. $2,000, $2,000, $2,000, $2,000, $18,000, $18,000, and so on and so forth. And the grand total income tax according to the tax return is $32,000. There you go, $32,000. Now there's a difference between what is going on with their financial statements in the tax code, and so I have the difference here. So in the first year, a $10,000 difference. 12,000 minus 2 is 10,000. In year 2, we've got a $14,000 difference. 16,000 minus 2 is 14,000. But in year 2003, the tax expense is only $2,000 according to GAAP, and $18,000 according to the tax returns. So the deferred tax liability is getting reversed. That is, the IRS is finally catching up. And in 2004, the same thing is happening. The IRS is catching up by $8,000. Now, when it's all said and done and everything's over with, the deferred tax liability is completely reversed out. So let's go down to the journal entries. So here we go with the journal entries. I left it all blank here because I figured this is the third time you've been through it, and you can help me out figure out where these numbers come from and how much it is. So here we go. Income tax expense, $12,000. We just get it off the chart right here. I've got it all color coordinated in case you are wondering. So here we are, $12,000 deferred. Let's go down to the income tax payable. Income tax payable, this is off the tax form. It's $2,000. And deferred tax liability, that's simply the difference between those two numbers, $10,000. Now the deferred tax liability to date is that $10,000. Pre-tax financial income, we could get that off of the top chart. It's $60,000. And the income tax expense, here we go. The current amount is what is due this year, what has to be paid to the IRS this very year. So it's going to be $2,000. And what has been deferred? $10,000. So take $2,000 and $10,000, add them together, and you get $12,000. Net income is going to be 60 minus 12, which is $48,000. So coming down to the second year. Second year is very similar. Income tax expense, it's all in blue here, folks. Get the $16,000 from right up above. And let's see here, $16,000 income tax payable is going to be $2,000. Get it right off the chart, and the difference between the two is $14,000. Make sure your journal entry balances. Deferred tax liability, what do you think it's going to be? Is it going to be $14,000? If you said $14,000, you are wrong. It's going to be $10,000 plus $14,000 because it is accumulating. $24,000, there we go. Pre-tax financial income, $80,000 comes from the very top chart. This is a GAAP income statement. Current, so what is due this year? Well, $2,000 is due this year to the IRS. And how much is being deferred? Well, the deferment is the difference. So the grand total income tax expense is $16,000, and we can double check here because we wrote it down right here, $16,000, and right there, $16,000. Going on to the third year. Here we go. Income tax expense. Hope you're seeing the pattern here. It's all in pink. So $2,000 for the tax expense. And income tax payable, what do they owe the IRS? Well, they owe $18,000. Now, the difference between these two is $16,000, and we've got to make this journal entry balance. So it's got to be a debit. 2 plus 16 equals 18. Here we go. So the deferred tax liability, what is it going to be? Well, we've got 10, and we added to it 14. That's 24 minus 16. What is that? $8,000, folks. Okay, coming over here to the income statement. Pre-tax income, 10. Get it off the top chart. Current, what's currently due to the IRS this year? Well, it's this big, giant $18,000. How much has been deferred? Well, we're reversing out the deferred liability. And so we get $2,000. 18 minus 16 is 2. We get it right off the chart here. The income tax expense is 2, and that's what should land right there. The net income will be 10 minus 2 is 8, $8,000. Coming down to the very last year. Here we go. It's all in this gray color. So the income tax expense, right up here, $2,000. Income taxes payable, they owe the IRS 10 grand. Deferred tax liability is the difference between the two, and we're reversing out the liability, so it has to be a debit. Our journal entry has to balance. So deferred tax liability, what's it going to be at the end of the fourth year? Well, we started with 10, added 14, minus 16, minus 8. If you do the math, you get 0. So here we go, 0. Pre-tax financial income, this is according to GAAP, it's from the top chart. Currently, what's got to be paid to the government this year? What is due this year? It's the 10 grand, that's what's payable. How much is the deferment being reversed out? It's being reversed out $8,000. That leaves us with to the income tax expense right there. Net income is going to be $8,000. Well, folks, I hope you enjoyed this video. I hope you found it easy. And if you want more of these videos, let me know. Hit that like button, hit the subscribe button. Help me out here so I know that you like them and these are helpful to you. Until then, over and out.